So the topic of today is stablecoins. As you know, the crypto market's been having a little bit of a rough time the last few weeks, and people more frequently ask me, is the crypto market here to stay? Where is the next big opportunity? Essentially, do we have anything to show after almost over a decade now of innovation in this space? And so to jump right in, first of all, I think it's worthwhile saying that, Bitcoin's been around for over 16 years, right? So we have been here for nearly 2 decades, which at this point, we're not that new of a technology anymore. Decentralized ledger technology is closing in on 2 decades. Now, with Bitcoin, of course, that also ushered in the era of decentralized ledger technology. Now, on one hand, it is, I think, without a doubt, it's very clear that Bitcoin has been the singular best store of value in the world for the last decade. What you see here is a little visualization by Vanek, where they highlight that Bitcoin was the best performing asset out of all the asset classes 9 of the last 12 years, right? And when you chart Bitcoin out, even against something like gold, it's been continuously rising over the last 12 years. Now, while that is true, well, before we get to that, and by now this belief has been taken not just from retail, which when I first got involved, 2016, 2017, back then it was mostly individuals betting on Bitcoin and crypto. But today, this belief has been, adopted by over 100 major companies and governments who together hold over 3 million BTC on their balance sheet, right? I mean, this is 3 million out of 21 is a major portion. Of course, some of this, is held by governments like the US, holding, I believe, over 200,000 in their strategic Bitcoin stockpile. Others are held by countries like El Salvador, or of course, a huge chunk is held by no other than Michael Saylor. And so by now, we're talking 164 entities and over 3 million BTC. So while all that is amazing, nevertheless, most people like you and me probably do not interface with Bitcoin that much day to day, right? We joked about this in 2017. Oh, you're not using your Bitcoin to buy coffee, or you're not using it for online commerce and so forth, right? And there was a period where people said, soon, it will, like the Lightning Network, right? All kinds of reasons why it would happen at some point. But the reality is, again, even 2017 is now it's like 8 years ago. It's been 8 years since the ICO mania, and it hasn't really happened. And at the same time, there have been early experiments where we tried to make Bitcoin legal tender, and it's largely proven unsuccessful. I don't know where the word unwent, but we meant to say unsuccessful, right? Because with El Salvador, for example, right, which was the first country that made headlines making Bitcoin legal tender meaning as a store, you're not allowed to reject the use of Bitcoin, right? And as a country, you have to accept Bitcoin as for taxes, for example, right? That means you can't be denied with your asset, right? That's when it's legal tender. And two things happened there. One, the IMF has been pushing harder and harder, saying like, you're too high risk for us. If you want to keep getting our money, our loans, you have to like slow your roll on this Bitcoin stuff, which could be seen as political, right? Where they say, oh, the IMF is afraid, they want to stop them. Okay, let's put it aside. The second piece is the actual, analysis of like, are people in El Salvador choosing to use Bitcoin? And what this survey found was that essentially the numbers have been declining year over year, where in 2021, about 25.7% were using Bitcoin for their transactions. Then in 2022, it dropped to 21%. Then in 2023 to 12%, and then in 2024 down to 8.1%. So even the first experiment of trying to use Bitcoin has been largely unsuccessful, right? And the point of these talks that we have every 2 weeks, again, I try to be as honest, as transparent as humanly possible, because yes, I run a crypto fund. And so like, people, usually what you hear from people in crypto is they are, kind of a one track record, where they always say the same thing, like everything's working, everything's going exactly as planned and so forth. But I think to truly make money in markets, you have to be intellectually honest. And so the truth is, Bitcoin hasn't been that successful as a method of payment. Now, Why is that? When you also look at the data, it's clear it's succeeded as a store of value, but in terms of transaction volume, right? In Q1, we were sitting at about the same transaction volume of Bitcoin that we had in Q4 of 2017. And again, somebody could say, oh, 2017 was peak mania. Sure, I'll give you that, right? You can't really say that we're the bottom of a bear market in Q1 when Bitcoin still was at $100,000 in Q1, right? And even if you were to say 2017 was peak, this right now is trough, right? Over a span of 7 years in an heavily accelerating technology, you got to see improvement. You got to see net, annualized growth. And we haven't, right? Why is that? The reasons are kind of numerous. Number one is that you have volatility, right? And this is not news. People know that, Bitcoin is quite volatile, but the volatility has actually been declining year over year. Right now, the average daily volatility is about 2.87%, which is, of course, less than where it used to be in the 10% plus range. But even with that, you're about 7 to 8 times higher than most FX pairs, right? Meaning euros, pounds, and so forth, right? Of course, that makes it hard to price your goods, right? Because some goods only have very small margin, and so you can't have your margin being taken away by daily fluctuations. The second piece is settlement time and throughput, right? So Bitcoin only transacts about 3 to 15 transactions per second. Yes, there's things like Lightning, but Lightning also becomes less decentralized, and there have been all kinds of technical issues with Lightning, which is why even today it hasn't taken off. So Bitcoin only does 3 to 5 transactions, even things on blockchain, right? So we're not saying blockchain failed, more so, hey, there's other blockchains that have done materially better. Like even, for example, Solana does about 65,000 transactions per second, right? Or when it comes to finality, with Bitcoin, you have to wait 10 minutes to get one confirmation, and you have to wait an hour to get finality. Finality meaning it's completely unlikely that this transaction can ever be reversed via a conflict in how the nodes view history, right? With Solana, getting one confirmation takes about 0.4 seconds, and getting full finality takes about 12 seconds, right? Now we're talking, okay, that at least would be a throughput in a settlement time that would surpass Visa and MasterCard, where commerce could actually happen. With 7 transactions a second and waiting an hour, I mean, forget about it. There's no way the global economy can run on that. So in a way, the market largely rejected Bitcoin as a medium of exchange. But, the benefits of blockchain remain valid. There is benefit in being decentralized. There is benefit in being instant, global, programmable, and so forth. And this is where we get to the crux of today's conversation, which is stablecoins. So stablecoins enter the picture where they combine the benefits of crypto, the speed, the security, the transparency, the low cost and fees, with the price stability for payments, trading, and savings that we're used to from fiat currency. Now, of course, fiat currency is not a store of value, right? If you held your assets in fiat, you lost tremendous amount of buying power, right? So the way to look at it is that, yes, you store your wealth in something like Bitcoin and other assets that, accrue value. But when you want to transact, when you want to do daily commerce, it probably will happen in stables. Even if you choose to, for example, keep all your assets, right, in Bitcoin, and then you borrow stables against it and then use those stables to do commerce. And so what we've been seeing from the numbers is pretty phenomenal, where despite bull markets, bear markets, and so forth, the total market of stablecoins has grown massively, more than virtually any other segment in the Web3 ecosystem. And so at this point, the total dollar amount of stablecoins is roughly $250 billion, which, if you want to get a comparison, is roughly 1%. I think it's north of 1% of the entire M2 money supply. So we've gotten the first percent of M2 money supply fully onboarded on chain. And why are stablecoins so interesting? Like, dollars on chain, are we really running out of ideas? No, it's actually quite innovative, because Stripe, in their annual letter, and this is a huge movement that's been happening where all the fintechs are realizing that the model is changing. We're moving from, having this complicated step of, there's card networks like Visa and MasterCard. There's card issuers. There are payment gateways. There are payment processors. There's all these middlemen that want to take a little chunk of your transaction, right? Many of these fintechs are realizing, whoa, this is all collapsing into one single source, which is the stablecoin. And so stablecoins have four important properties. So this is per the annual shareholder letter, where they said stablecoins have four important properties relative to the status quo. They make money movement cheaper. They make money movement faster. They're decentralized and open access. That's globally available from day one. And they're programmable, right? Everything interesting follows from these characteristics. So fast, cheap, global, programmable. Those are the four things you need to remember. And the growth is happening before our eyes. Why is it an opportunity? Why are people paying attention to it? Why are governments discussing stablecoin regulation? Why are fintechs investing in it? The market size is just phenomenally large, because what we're looking at is the business-to-business payments in the world. Currently, is about $40 trillion a year, and it will likely grow to $60 trillion a year. B2C commerce is already at about $5 trillion a year, and that's growing to about $15 trillion a year, right? And then there is global remittances, which is currently maybe $1 trillion and growing to about $6 trillion, right? So B2B, of course, business paying each other. B2C would be, anytime you buy something online, like from a Shopify store, right? And then global remittances is people sending money across borders, to their families, for example. And where is that being captured, right? A huge chunk is through the ACH network, then the interbank system, and then Visa. And then we actually already get to stablecoins, right? And so there's two different stablecoin numbers. One is adjusted for taking away anything that they don't consider organic, maybe some like wash trading that has stablecoins in it, right? But ultimately, stablecoins have already surpassed PayPal, and they're growing rapidly fast, becoming soon as big as MasterCard and Visa. Why do these fintechs care, right? The killer app is that right now it can save a ton of money and be instant. And so when it comes to cost, the average global for remittance cost is about 6.5%. So the average transaction loses 6.5%. You might say that sounds very high, right? Because if I use PayPal, I think the average consumer spends about 3% plus 30 cents on every PayPal transaction, right? But that's just the payment gateway. That's just the payment processor, right? You also have, when you do remittances, the FX transaction costs, where like if I did this where I wired money from America to Germany, right? So two first world countries using a national bank, like Wells Fargo, I lost about 7% of my transaction doing so, because the bank will upcharge you a much higher FX rate. Then you got high wire fees on both sides. And essentially, you might even be worse off if you use a community bank, because then there is the intermediary banks that all want to take a cut. So long story short, the cost can be pretty high. And while there are now opportunities in fintech like Wise, TransferWise, right? They still fall within the ballpark of what that is. So while other competitors might charge 7-8%, a Wise might fall on the bottom bracket, but it is still all the way up there. When it comes to crypto, we've now consolidated costs down massively, where if you want to send a token, right? This is what we see here on the left side. Sending tokens on the Ethereum ecosystem can be as cheap as 4 cents or as expensive as $3 if you do it on the actual Ethereum layer 1. If you do it on Solana, it will be a fraction of a cent. So we've already gotten to the point where you can move money for virtually or almost free, right? Breaking this graph on the right completely. And so now most are realizing, hey, why should I continue using, banks and so forth to move money when I can do it fully on chain? And the interesting point why we think there's going to be acceleration is that this is actually one of Trump's last crypto campaign promises. What you see on the left side is a tweet I sent on July of 27, 2024. This is the day that Trump gave a talk at the Bitcoin conference, where he went on stage and rattled off a number of different promises he was going to make to the industry. The first of which was that he was going to fire Gary Gensler on day one. Gary heard that message loud and clear and resigned before he could even get there. Then he promised that we would continue to support the right to self-custody, right? And shortly after, we've had all kinds of lawsuits against Uniswap, against Coinbase, and so forth getting dropped by the SEC. Then he promised a stablecoin framework, which we'll get to later. Fourth, he mentioned he would end Operation Choke Point, which was the discrimination against the crypto industry in the banking space, where crypto company after crypto company, myself included, would get debanked by our banks, right? Like when I first started, I used Silvergate. At some point, Silvergate got killed by the feds and all crypto companies scrambled to find a new bank, right? At some point, I used Customers Bank. Then they went to the juggler of Customers Bank sometime in 2024 where they said, sorry, we gotta reduce our book on the crypto industry. Unfortunately, please find a new bank, right? And so this happened over and over and over again and other names I didn't even join, like Signature Bank, also got killed, right? So that is officially ending now, where Trump is filing an executive order to reverse the Biden banking restrictions, and the House I think it's the House Financial Service Committee. I might get the name wrong, but the House is essentially investigating what happened during the Biden administration when it comes to the banking discrimination, right? Then he said we would deregulate and support onshoring crypto. We just had our first crypto summit at the White House where all the leaders got invited. Then Bitcoin is not a threat to the dollar. Well, we just established a Bitcoin strategic stockpile, which, by the way, he actually mentioned on stage. He said, all the Bitcoins we seized, we will not be selling and we'll be creating a strategic Bitcoin stockpile. So all the speculation about a reserve that was happening the last few months, he literally said it verbatim on the stage of the Bitcoin conference. And so when you look at all the promises, the one that's left really is a stablecoin framework. And having talked to some people in Washington, that seems to be the most bipartisan issue where you're likely going to see the first action, right? Before you see sweeping, reforms about NFTs or meme coins and so forth, right? Stable coins that make commerce cheaper for the average American are fairly center of view right now for Congress when it comes to technology innovation, technology regulation. It's AI and stablecoins essentially. And so that's where we're going to see the most amount of progress in the next 2 years, I would say. Now, crypto, again, as a long-term crypto advocate and as a long-term crypto investor, I think the honest thing is to acknowledge that crypto has not lived up to all of its promises, and many innovations fell flat over the last few years. Crypto's had a ton of experimentation, right? Where NFTs went nuts and then they went to zero. And of course, there's still art collectibles with NFTs. And of course, there's still NFTs in gameplay. Maybe NFTs were never meant to be a speculative asset, but rather, again, be a way for us to track, non-fungible digital goods, right? So for example, so that you can that you can own the sword that you have in the game, but that doesn't mean that the sword is going to be worth $100,000, right? Those are two different things: the financialization and the ownership. And of course, things like DePIN, right? Where DePIN, you've got Helium and Akash, they're growing, right? But they're still somewhat materially overvalued, where they might be doing $1 million in revenue, yet they're worth $1 billion, and so they're going to have a hard time to, I guess, impress you financially when they're already 1,000x their revenue. But even more so, when you look at the trajectory of other technologies, a lot of other technologies took off a lot faster, right? All that being said, stablecoins, without a doubt, have found product market fit, and they're ready for prime time because the regulation is there and it's coming. The fintechs have adopted it. For example, Stripe, right, the biggest private fintech in the world, acquired a stablecoin platform, Bridge, for $1.1 billion this year. Not in a mania phase, but this year because they know it's time, right? And so the fintechs are in, the government is in, and the traction is there, right? It's one of the only sectors that's been growing year over year and now has 1% of M2 money supply. So like last time when we met, the question is, okay, this is interesting, this is nice, it's philosophical, but how do we take action? How can investors actually take advantage of this trend if, for example, we say stablecoins are going to go from 1% of M2 money supply to 10% in the next 5 years, in the next 10 years? And then you do the math. Well, if the M2 money supply currently serves, call it $70 trillion of annual volume between B2B, B2C, and remittances. 70 trillion. If we can capture, if stable coins are cheaper than the incumbents that charge on average, again, high percentages, if we can get that down to a few basis points, well, even 10 basis points of 70 trillion is a massive, massive market a year in terms of revenues. How do we capture that? So we break down the stablecoin opportunity into 4 buckets. 4 buckets like last time. It won't always be 4, but this time it was 4. And they are issuers, they're settlement layers, they're centralized and decentralized finance, and they are payment gateways. Okay. Some of this will be crypto, some of this will not be crypto. So we'll talk about it. So starting with issuers, first of all, not all stablecoins are created equal. When I say issuers, I essentially mean the company behind creating a stablecoin. And so there are multiple different ways to issue a stablecoin. You can have them being backed by dollars. You can have them being backed by assets in an over-collateralized fashion or in a fractional reserve way. You can create them synthetically, or you can create them algorithmically. And we'll talk about every single one of these with specific examples in a minute. But here on the right side, you see the list of stablecoins that are out there. This cuts off. This will keep going for probably another 100 plus or so. But there's many experiments of making stablecoins work. And so the biggest one is, of course, dollar-backed. And the top 3 dollar-backed stablecoins are one, Tether, USDT. Okay, important name to remember. Tether, you'll hear it every once in a while. Key to the industry. Second one is USDC, which is issued by Circle, which is an American fintech company. And third, you've got PayPal USD, done by no other than PayPal itself, with only 650 million. So there's a clear leadership with Tether and USDC, right? With a pretty massive gap down to number 3. And these are very simple. They are one-to-one backed by cash and cash equivalents, right? So like US treasuries, notes, and so forth. And there's been a lot of speculation over the years, like, is Tether fully backed? Are they audited? All these companies have over time released various attestations, various audits, and so forth. In fact, by now, Tether does about $10 billion a year in profit. So I highly doubt that they're under-collateralized. But that's been a story that's been going around crypto every 3 months, perhaps. Now, who are they backed by? This is also just as important, because Tether and USDC are not just super powerful in terms of assets, but also they've got some important stakeholders. So Tether is surprisingly largely privately held. The CFO, I think his name is Giancarlo, he owns about 47% of the company, making him worth about $10 billion personally. He's one of the richest people in the world now. And then the CEO and formerly CTO, Paolo, he owns about 20%. So just between those two guys, about 70% of the company is held just with 2 individuals. Then, very importantly, there's Cantor Fitzgerald. So Cantor Fitzgerald is the company that essentially custodies most of the treasuries for Tether. Now, interestingly enough, the CEO, Howard Lutnick, was recently appointed as the Secretary of Commerce under Donald Trump. And Cantor Fitzgerald has acquired about 5% of Tether. So now the guy that runs commerce for the United States and sits in the same room as Trump owns 5% of the world's largest stablecoin. There's signal in that, right? And then when it comes to USDC, USDC has been essentially the Wall Street darling, where the Series C was led by Goldman Sachs. They had a private equity round with BlackRock and Fidelity. And then Coinbase did a strategic partnership where Coinbase acquired 3.5%. I'm not even sure if they exchanged dollars for it. It's possible they did. But really what happened here was that USDC became the official stablecoin for Coinbase, where you can now instantly, with one click, swap dollars for USDC. And Coinbase offers all kinds of trading pairs with the USDC. Coinbase allows you to earn interest on your USDC. So really, they are the front end for the masses when it comes to USDC. Then we have asset-backed tokens. And so the most popular name there is MakerDAO. You might have heard of it, you might have not, but MakerDAO essentially is the biggest decentralized central bank, where essentially in the early days, people used to deposit their Ethereum, they used to deposit it at the Bitcoin, and then there was the maker token holders could vote, hey, what's the debt ceiling that we allow against this? How much can we issue in synthetic fiat currency, essentially, which was called DAI at the time, DAI. And essentially, they would charge an interest rate, and they would make, in a fully decentralized way, decide interest rates, debt ceilings, collateral types, and so forth. Truly fascinating. This is an experiment that's been going on for many, many years. I think Rune, the founder of Maker, first concepted the idea, I think, in 2013. And then I think it launched in somewhere between 2014 and 2017, in that time frame. And Maker's been running ever since very smoothly. You have been crises along the way. There was one crisis once where in the COVID crash of 2020, they didn't liquidate collateral fast enough, and they were under-collateralized for like a day. And then they just minted more Maker tokens, sold them, and they were back to peg. By now, the system has been transformed quite a bit, where it's no longer called DAI, now it's called USDS, because they tried to call it Sky for whatever reason. And the stable coins that they have, which is 8 billion worth of stable coins, right? Not as much as USDC at 60 or Tether at 150, but it's a lot. So there's 8 billion in synthetic decentralized stable coins that exist, and they're currently backed by 10 billion in collateral. While back in the day, they used to be backed by ETH and Bitcoin, it's largely backed by other stable coins now, which people have criticized because these centralized stable coins like Tether and USDC, they can actually be seized, they can be frozen, because they have central control switches where essentially you say, hey, this money got stolen by terrorists, they could essentially blacklist those wallets, right? DAI was initially loved for not being able to do that, right? But by now it's, sorry, I'm jumping around, but by now it's largely backed by stablecoins. And so the token is MKR, and the stablecoin is USDS. And it's been largely stable, as you can see here. Up next, you got synthetic stablecoins, where the most popular name is Ethena, under the ticker symbol ENA, and the stablecoin USDE. And they got about 5.5 billion in stablecoins. Of all the ones I've mentioned so far, this one has been the least stress tested. It is fairly young. It is fairly new, right? The way they go about it is they said, well, instead of having assets back it, instead of having collateral risk and volatility risk, right? Instead of being pegged to the US dollar, there's a new way to achieve stability. You achieve stability by, imagine you own Ethereum and Bitcoin, and then you delta hedge by shorting the same amount of Bitcoin and Ethereum. Now all of a sudden, if I'm long one ETH and short one ETH, how long am I? How long am I? 0, right? So essentially, you are able to achieve stability without necessarily having dollar exposure, right? And at the same time, that was the logic initially, is that they should be able to do this profitably. Why? Because funding rates, traditionally, if you're long the asset and short, you will get paid to be short because of the, because futures, essentially, you have to pay a funding fee for the time until expiration. Or in perps, there's just a perpetual funding rate that usually tends to be about 0.01% every 8 hours, right? So it comes out to, historically, you can make about 10% doing so, right? 10, 15, 18%, depending on the market cycle. Now, where this is new, and this hasn't been stress tested, is that funding rates can also go negative, right? So like, for example, when everybody's bearish and everybody's shorting, all of a sudden people actually pay money to short, and those being long get paid. So we haven't been through a period long enough where that was the case, where Ethena sustained. Because what happens if, let's say there's a 2-year bear market, and Ethena sits on a ton of ETH, everybody's shorting ETH, and now Ethena is bleeding funding rates every single day. So it is an experiment where I would say over a long enough time horizon, it will fail, but medium term, there's no reason to be concerned. I don't have exposure to Ethena, but it has been a very, very popular trade over the last few months. And then last but not least, you've got algorithmic stable coins, which I will just say yikes to. So you'll see a bunch of graphs overlaid here. So famous ones, the most famous one is UST. UST was the one that's tied to Terra Luna, which you might have heard of. UST at the peak had $20 billion in assets. So it was at the time climbing up to Circle's level, USDC. It had flipped most of the others. And essentially what happened, like these are all kinds of unique systems, and we're not going to go too much into it. But for example, with Terra Luna, what they did is they did a seniorage system where essentially every time when there's enough demand for UST, right? What happens if enough people buy UST? The price of UST goes up. If it goes to like $1.01, right? They would burn UST and issue Luna. I'm not trying to get it wrong. It's been like 3 years by now. But essentially, when there's enough demand for UST, you burn Luna. And when there is not enough demand for UST, meaning when it drops below 99 cents, right? Oh yeah, so of course, yeah. When there's too much demand, UST goes over $1, you issue UST, you burn Luna, right? If it falls under $1, right, you burn UST, meaning supply reduction, right? Less supply, more demand. So UST should go back to $1, and you issue Luna. So what does it mean? When there's a ton of demand for UST, price of Luna goes up. When there is a declining demand for UST, price of Luna goes down because there's a ton of issuance, right? So what happened is essentially is that 80% of UST was just locked up in this one app product called Anchor, where they just gave people free 20% interest, right? Hey, where can you get a 20% savings account? Nowhere, right? So there was, of the 20 billion, there's about 16 billion inside that one product. That one product ran out of money, and they said, we're going to cut the interest rates lower. So people said, this looks dangerous. I'm going to pull my money. And so when everybody started pulling their money and UST value dropped tremendously, what happens? To stabilize it, issue Luna, issue Luna, issue Luna, issue Luna. And all of a sudden, you had the Luna token, which at the peak was $100 billion roughly, collapse to zero, more or less, right? So that was an unsustainable flywheel, not very well thought through. And it was mostly vulnerable because, again, 80% of the performance was demand driven, and the demand was all tied up in a single product. Little history lesson. Now, the history essentially tells you that virtually all algorithmic stablecoins fail. There are few exceptions. Like, for example, there's a token called Ample, which Ampleforth. That's been around for a while. I traded it back in 2020 during DeFi summer. It is still around. It's alive, but can you call it stable? I don't know, right? So essentially the way Ampleforth works is whenever I think Ample goes over $1.20, it issues more Ample. When it goes below 80 cents, it burns more Ample. So it's similar to Luna, except they kept it in one token, not two tokens, which makes it a little bit more resilient. And essentially the range is 50 cents to $2. So is it somewhat stable? Yes. Is it a stable coin? Not really. I mean, Bitcoin is probably just as volatile. So you might as well use Bitcoin, right? So those are kind of the choices. And the market consensus favors dollar-backed stablecoins. Like when we just look at where is the traction, right? The traction is in USDT and it is in USDC. And if you're intellectually honest, you will throw USDS in there too, meaning MakerDAO, because MakerDAO is something like 80% backed by stablecoins. So it kind of is a dollar-backed stablecoin as well, right? So ultimately, the market has decided that this is what we trust currently. There will continue to be experiments, but I would trade experiments as a hedge fund, but I probably wouldn't trust it with my savings, or I wouldn't trust it with my commerce, because you don't know how stable it is, right? Again, there's plenty of examples. So USDT and USDC, and it's important, I wanted to separate these issuers because somebody in Congress hears Terra Luna stablecoin collapsed, UST, and then they say all stablecoins are wishy-washy, they're dangerous. It's just not the case. It's completely different ways of approaching them. And the dollar-pegged ones have been perfectly stable, ranging from like 98 cents on a bad day, like when Silicon Valley Bank collapsed, to like $1.01 on a good day, right? So like we're really talking stable here. And so now the question is, okay, it looks like the winning is going to USDT and USDC. Now, besides investing in Circle or Tether via private market secondaries, who stands to benefit? And truthfully, USD Circle, you can buy secondaries. That is a market that exists because it's been funded by tons of private equity firms, VCs, and so forth. Yes. Tether, I don't think you can even buy interest in Tether if you wanted to. I'm not aware. I've never heard of a Tether transaction, essentially, because again, it's so largely privately held. So the other three buckets come up next. So first of all, we have settlement layers, right? Because no, it's not the end of crypto if stablecoins win. If anything, crypto wins if stablecoins win. The top where like Circle and USDT are the issuers, right? They created the tokens. They take care of the collateralization, right? But those stablecoins still act on blockchains. And where are they held? Right now, about 54% of all the stablecoins in the world are settled on Ethereum. Another 27% are settled on Tron. Now, that one might surprise a lot of people, but what's interesting is that Tron and USDT are used in countless second and third world countries, essentially, because for them, it's the cheapest way of, one, getting exposure to dollars when their local currencies are actually a lot weaker. And two, it's incredibly, incredibly cheap, again, fractions of pennies to transact. So they can actually send remittances cross-country. And then the third one is Solana, which of course, is a much higher throughput chain than Ethereum. That's now already won over 5% of settlement value. Now, why does settlement value matter, right? When you look at Ethereum, and this is just the last 7 days, for example, there's a website called Ultrasound Money where it shows you exactly where does Ethereum earn its fees from, right? Because Ethereum, every time you make a transaction, it charges a fee, a gas fee. And a part of that gas fee gets burned. A part of that gas fee gets given to validators, right? So you can look at two ways. If it's just a passive hold of Ethereum, Ethereum can get more scarce because of gas fees burning up Ethereum. Or if you're an active participant in Ethereum and you're staking it, right, you're actually earning a dividend, right? So you're earning a dividend and the supply is becoming more scarce. Now, the interesting thing is that the single largest contributor in fees for Ethereum are stablecoins. And so you'll see that on the burn leaderboard, coming in at number 2 is Tether, which in the last 7 days burned about 75 Ethereum. And then coming in at number 5 is Circle, USDC, coming in with 41 ETH. This doesn't even mention things like, MakerDAO, Sky, and so forth, and Ethena, which might be additional. But these are just the top 2 stablecoin issuers already combined, burning up more than 50% more than the number 1 use case, which is transfers. So that's truly impressive. And when we say, hey, if ETH is already able to earn billions in revenue just with 1% in M2 money supply, imagine we get to 10% of M2 money supply, right? Again, and it's just the stablecoin use case. And it doesn't even get into the ripple effects of onboarding digital tokenized stocks, onboarding tokenized real estate, tokenized gold, and so forth, right? When all the assets start being tokenized, that's the real game where blockchains can make a ton of money in fees. The third part is centralized and decentralized finance offering stablecoin utility. So when we just look at Etherscan, folks, so we said, okay, most stablecoins on Ethereum. So then we can go to Etherscan and see, hey, where is the stablecoin living on Ethereum? And what you'll very quickly see is that you see 3 different common use cases. One, you see this name called Aave, which is the biggest decentralized lending market in the world, which we'll talk about in a second. Then you see Binance quite a bit, right? And then you see things like Stargate or Polygon Bridge, right? So 3 of the big current places where stablecoins are parked are exchanges, lending and borrowing, and bridges. Okay, exchanges. Well, guess what? Most exchanges, like Binance, for example, it is not, or Bybit, it's not Bitcoin against US dollars. It's Bitcoin against Tether. It's Bitcoin against USDT, right? So there's a lot of stablecoin volume happening against any on-chain assets. So it's very native, and on DeFi, a lot of times, it's against USDC. So if we see an increase in the amount of assets being tokenized, right? Like, for example, tokenized stocks, right? They will most likely be trading not against dollars, because you can't just have dollars. They'll be trading against stablecoins. They'll be trading against USDC. They'll be trading against USDT. Okay, so ergo, if we see an increase in the demand for stablecoins, exchanges will benefit from it, right? Lending and borrowing right here is a snapshot of all the stable assets held on Aave 3.0, which if you combine them all up, we're talking about roughly $7 billion. So $7 billion of stablecoins is currently sitting on Aave. What can you do on Aave? On Aave, you can deposit your stablecoin and earn yield, right? Just like a bank, you deposit in a savings account. Or you can borrow. So let's say you've got some Bitcoin and you want to take a loan out, you do that on Aave, right? So it's a fully decentralized lending market that's peer-to-peer, meaning users deposit stablecoin and earn a yield, which is then given to borrowers who pay the yield, right? Incredible product. Again, one of the products that has the most amount of product market fit. Again, I think 13 billion in deposits across all of Aave, right? With like huge amount of deposits, right? They're doing real revenue, real users, cross-chain. That's one of the places that will benefit. And then of course, there's bridges. Bridges essentially allow you to move money from one chain to another. How do you move USDC from Ethereum to Tron, or from Ethereum to Solana, right? That's where bridges come in, and bridges, kind of like a toll booth, they charge a small fee when you move money from one place to the other, right? So these will all benefit from stablecoin proliferation. And now the final point, and this is again because we're hosting an investor education session here that's not just crypto. Like, I just want to see how can I play this idea the best way possible. Circle is a good way, but that's private equity, right? You have to get secondary somewhere, right? Aave is a very straightforward way we can buy it on an exchange like Coinbase, right? Like as an actual token, right? Or Ethereum, Solana, of course, right? The final way is equities, right? So payment gateways, current fintech is very much jumping on the opportunity to see how can we earn the stablecoin business. And what's interesting here is that almost all the big fintechs have gotten involved in it. So PayPal, which has 434 million active accounts, launched their own stablecoin. Then there's Block. In case you don't know the name, they've rebranded. They used to be called Square. You might know Square, right? Every time you check out in a store with the little square, right, you pay. That company, which is also run by Jack Dorsey, the founder of Twitter, who is a hardcore pro-crypto fanatic, and people even say he might be Satoshi. I don't know. They have 57 million users with 4 million vendors using the Square checkout, right? They were one of the first to offer mobile crypto wallets in the Cash app, right? Where all of a sudden the masses had crypto, right? Then there's Stripe, which is used by 4.8 million websites for payments. And they acquired stablecoin platform Bridge for $1.1 billion this February. That was the biggest acquisition in crypto history. And then finally, you've got Klarna with 150 million active users, where the CEO went to Twitter in February and said, okay, I give up. Klarna and me will embrace crypto. More to come. Yes, I know. This post will get a huge sigh and 2 views, but it still feels historic. Last large fintech in the world to embrace it. Last. Someone had to be last. And that's a milestone as well of some sort, So all these players will start pushing stablecoins if they're not already, right? So you might say, well, I'm not going to make a MetaMask wallet and, start doing checkouts with a nano ledger to pay my USDC. You won't have to. USDC will be accessible through your PayPal account, through your Stripe account, through your Square Cash account, through Klarna, through Revolut, through Robinhood. Again, all these are names that are actually involved in this, right? And even if it is accessible through the interface of these, it still settles on chain. And if they want to get loans against it and so forth, there's still a high likelihood they're using something like Aave in the backend. And if they want to move it from one chain to another, they still need to use a bridge, right? So many of these are publicly traded, like PayPal is public, Block is public. I believe Stripe and Klarna are both. I think Klarna might be public and then Stripe is private, right? But these are other ways to express the idea. So there's a fifth bucket, of course. I promise I won't pitch, but of course, you can also make an allocation in a digital asset fund that focuses on capturing this opportunity as it evolves. That's something we do, which of course is why we spend so much time thinking about these various different opportunities. So with that, the final thought is this. Stablecoins have hit critical mass, surpassing $250 billion in assets, which is roughly 1% of M2 money supply. They're cheaper, faster, global, and programmable, which is reshaping the financial landscape. Fintech has embraced it. PayPal, Stripe, Block, Klarna, Revolut, Robinhood, you name it, and others. Even banks now. Bank of America said they want to launch their own stablecoin. So all these players are integrating stablecoins into the ecosystem. Now, stablecoins have a green light in the White House, with the sitting U.S. Secretary of Commerce holding a 5% stake in the world's largest stablecoin. So ultimately, Bitcoin might replace gold. Yes, it's digital gold. It's a great store of value. But stablecoins and the companies innovating around them are set to disrupt every layer of finance, from the banks to the payment process to the card networks to the card issues to the payment gateways. Essentially, the entire flow of global commerce is changing. So now the question is, what's your play? Hope you enjoyed the session. And now I'm open to jump in some Q&A. If you have any questions, if you found we can dive a lot deeper, because one part that I didn't even get to, I initially was going to make slides, but I figured we're going to use the full hour. It's already 9:48. Is the tokenization of other assets, right? Because essentially stable coins are just day one. And I think once we won over dollars on chain, it's very, very likely that shortly thereafter, you're going to have the tokenization of stocks. And I did talk about this in my write-up. I didn't mention it here. But Coinbase, for example, announced that they're working on tokenizing the Coinbase ticker, so that you will be able to buy fully backed, legitimate, authentic Coinbase stock on the blockchain. So that way you can keep your Coinbase stock in a wallet somewhere. And Coinbase, of course, is the ideal first experiment because they are the crypto industry to some degree. And if Coinbase pulls off successfully, right, you're going to have dozens and then hundreds and then everybody follow suit. And then it becomes interesting because then all your entire financial life can live inside a wallet. Oscar asked a question, and live. MakerDAO got rebranded last year. I know it's called Sky. The coin is down to roughly 1K per coin. Do you think the rebranding will have a positive impact? I think the rebrand was a mistake. I get that they wanted to go from MakerDAO to Sky and make Sky like something a little bit more mainstream, 3 letters, but first of all, Sky, you've got the internet, the TV streaming in Europe that's called Sky. You've got SkyCon, which was like a scammy deep in play. I think it was silly. Plus, Maker has so much brand equity as one of the OG projects. I don't think rebranding is gonna change much. I'm also not the biggest fan of their strategic changes, right? So the strategic change to make DAI USDS virtually fully backed by stable coins and by real world assets. They got the credit deal with Block Tower, or Block Tower's got 1.6 billion or so in treasuries. It seems silly, honestly. Because if I wanted that, I'm going to use USDC. Why would I use USDS, right? USDS to me had appeal because it was not censorable by something like Circle. It was not censorable, right? It was not seizable. It was completely transparently over collateralized by assets that the community deemed worthwhile. So I don't know. I think Makers has a little bit of an identity crisis, right? Makers an identity crisis because it's not a dollar-backed stablecoin, but it's also not really a fully decentralized stablecoin anymore. So I don't think you can play this middle course. You have to be decisively one way or the other. Marcel asked, you mentioned BTC's digital gold. Do you see Saylor as systemic risk for BTC and the role of crypto assets? Definitionally, Bitcoin doesn't have systemic risks. So can Michael Saylor end Bitcoin? No. Can Michael Saylor cause a bear market? Yes. Right? Two different things, right? If Michael Saylor, for example, keeps over leveraging and then Bitcoin goes into a 2-year slump, his nodes start hitting expiration, his and a lot of his convertibles are trading are below, the market's trading below the strike of his nodes. Some people might want to convert, right? It could cause somewhat of a stampede where people want to exit their holdings with MicroStrategy, and MicroStrategy essentially is forced to liquidate to make borrowers whole. something like that could happen. Very hard to happen because he actually did construct it intelligently, meaning a lot of his debts have 0% interest. Most of his debts are years out, like 20, 30 maturities, right? So he's kind of safe as long as Bitcoin keeps compounding, let's say over a 3-year horizon. If Bitcoin is more valuable than before every 3 years, he should be fine, right? Again, usually in finance, leverage gets punished over a longer time horizon. Eventually, he will get punished. And there's a chance that he will drag the market down with him, right? But again, Bitcoin will keep chugging out transactions the same it did before. Okay, let me balance out the question, the Q&A, and in the chat. What is your view of RWA on assets like real estate or ships or planes? Not bullish near term. Not bullish near term. The tokenization of assets makes the most sense if they already are predominantly digital, right? So, for example, like me owning a stock of like a share of Tesla, right? It's already a digital experience. It's just an entry in a register somewhere, right? It's with a clearinghouse, where it's very easy to tokenize that. Now, the issue with tokenizing real estate is that like there are real costs. Like tokenizing real estate almost also requires fully tokenizing the governance of that real estate. Because okay, let's say we're in Los Angeles, fire happens, house burns down, right? You now got to vote. Like, do you rebuild? Do you sell the plot of land, right? There are costs associated with it, right? So we all own tokens, and there's property taxes. Who pays the property taxes? Okay, we all need to send in our money. What if one of us doesn't send in the money, right? What if who pays security costs, right? And all these, the problem is that all these questions are different case by case, right? If it's like a very expensive multi-million-dollar, like not like, you know, we're talking like a $50 million mansion, let's say, for example, like you'll need security. Okay, who pays for that, right? And that's not the same that a house that costs 500,000, that's worth 500,000 probably doesn't need security. Maybe it's got an ADT, you know, or Prinks, you know, installed, right? So I think there's a lot of, to keep it simple, there's a lot of complexity. There's a lot of complexity that comes with physical assets because physical assets can deteriorate. Physical assets have location and security risks. Physical assets have unique different taxes, meaning all capital gain, like all corporations are taxed the same federally, right? And they all live in Delaware, more or less, right? But the property taxes will literally change based on what municipality you live in. Makes it more complex. So will we figure it out long term? Yes. Short term, not so bullish. JPS, which stablecoin becomes standard, or will it look like payment processors that take multiple cards? That's a decent question. See, I'm actually thinking about this one. You know, I think there's two paths. There's two paths. You're gonna either have three paths. Okay, three paths. One is corporate monopoly, meaning you have something like USDC win over the West, USDT win over the East. Likely scenario. Option two is you're gonna have at some point the government says we're gonna issue our own stablecoin, which is called CBDCs. Trump has said we will never do a CBDC. So at least the current administration is anti-CBDC. Doesn't mean all of them. Europe, for example, loves CBDCs, right? So I think Lagarde says we want to do our own CBDC. People in the private sector don't love that because that can become very Orwellian quickly. If the government can, like, you know, trace every single transaction you do on a blockchain, freeze your assets, and so forth, and so, you know, not the best. And then the third one is, let's say you have hundreds of stablecoins. Bank of America has their own stablecoin, and JP Morgan has JP Morgan coin, and then PayPal has PayPal USD, right? At that point, you likely have aggregators or even an aggregator stablecoin, where there will be technology for it. In DeFi, we've solved for this already on a small scale, where there's a project called Curve Finance, for example, where Curve has these stablecoin pools, where there's a pool of USDC, USDT, and maybe some DAI, and maybe some Frax, and so forth, right? And that ensures that they all trade at peg, and you can always exchange one for the other, right? Something like that will probably exist if stablecoins proliferate, where everybody wants to be an issuer. What I could imagine happening is that everybody will initially try to be an issuer because there's a lot of money in being an issuer, but there will be winners and there will be losers, right? Very simple market example would be Bitcoin ETFs. Did everybody and their mother on Wall Street try to launch a Bitcoin ETF? Yes, there's like 12 ETFs at this point, right? Does 90% of the money flow into 2 or 3 names? Yes, right? It's BlackRock, it's Fidelity, and then it's the leftover from Grayscale. And then everybody else is crumbs, it's pocket change, essentially, right? No disrespect, but in case some of them are here, possible. Gil asks, as a hedge fund, are primarily focused only on liquid investments for ecosystem players within the stablecoin EG omnichain. As a hedge fund, are primarily focused only on liquid investments for ecosystem players within the stablecoin EG omnichain payment orchestration protocol. Well, in my case, for example, like we have a wide mandate, so I could invest in Circle, and I can have that as a side pocket, right? Per mandate, I'm allowed to have crypto-adjacent stocks. So if I wanted to, I could buy the fintechs, right? So we have a fairly wide mandate. Right now, this moment, I'm risk off. We're very hard in cash and stables, ironically, because a lot of long-term trends in crypto have been breaking independently, and then of course there's macro pressure, right? So to me, I think the next 3 to 6 months will probably give some really awesome opportunities to dollar cost average into some of these ideas, whether they are on-chain tokens like an Aave, whether they are equities, like maybe a Block or a PayPal, or they are blockchains like Ethereum, Solana, or doing some secondary deals, right? Seeing if somebody wants to sell me the Circle. In which time frame do you expect the stablecoin framework? I would say, well, there's different stages. There is introduced to the House of the Senate, discuss it, vote on it. It goes to the next chamber. Then they discuss it, they vote on it. It goes to the president. He signs it, and then there's adoption, right? I would say the odds that it passes one of the chambers is, I would place it 90% in the next 2 to 6 months. Because this administration does not waste time. Like real talk. Don't love him, hate him, doesn't matter. But like Trump has only been in office for like 50 days. He has not been in office for more than 2 months, and like whether for good or worse. I mean, like some of the stuff, whatever, but a lot happens. A lot happens, right? Like he had made all these crypto campaign promises, and he's like checkboxing them in the first 30 days. And I have talked with people in Washington, and essentially the thought was, somebody quoted to me that the plan was to launch the stablecoin framework, and also something like essentially get Fit 21 through in like the first or second week of his election. Like after his inauguration. But then, because he launched the Trump meme coin, he pissed off some people that they needed to also vote for it, because you do need over 50%, right? And you might see on TV, like, why is it that all the Republicans always vote pro something and all the Democrats always vote against something? And it's almost always a very clean party line. The reason that happens is not necessarily because everybody just votes party line. It's because the voting happens before the voting, right? Before you put something up for a vote, before you bring it to the Senate floor, the House floor, right? A lot of in-party lobbying happens, right? Go watch some TV shows like, House of Cards or West Wing or whatever, and you probably see this, right? Where essentially, they say, like, there's one guy on the team that's like, I hate this crypto shit, but I'm a Republican. So now you need to talk to that guy and get him on your page. What concessions are you making? What are you leaving out of that bill that he really, really hates, right? Or what else are you giving him, right? And then comes the day that the voting happens, and all of a sudden everybody falls in line, right? Now, the meme coin shit with Trump coin really hurt getting everybody in line. That's what I've been told from up above, so to say. And but it's only been delayed. It's not canceled out, right? It's just delayed. And so essentially what he even said is that it probably strips down the near-term actions from being very holistic, getting clarity on what is a security, what's a token, and so forth, to let's start with stablecoins, because that's like the easiest pill to swallow, so to say, like to get some momentum going. Yeah. Awesome. Let me jump to the final questions in the Q&A, because I know we hit the hour mark, and I know a lot of you guys have calls coming up. I do want to give a quick shout out to all the people that joined. We see Andy, Armin, Connor, David, Erkin, Frank, Jonathan, Lee, Marcel, Max, Michael, Moritz, Oscar, Simon. I also saw we had Gil in the house before, JP, and several others. Appreciate a lot of our LPs. Appreciate you guys joining in. I think a verbal session a lot of times is much easier than the write-ups. I did the write-up also, but I think with these presentations, you can get a lot more depth. So let me just quickly finish the last 4 questions. How will stablecoins affect the business models of companies who are in financial services businesses, specializing in the management of foreign exchange risk for corporate businesses? How will stablecoins affect the business models of companies who are in financial service businesses specializing in the management of foreign exchange risk? Interesting. I mean, it's probably the same. That shouldn't change. And I'll tell you why it won't change. Because you will have USDT. I think is it EURC? There's like a euro. There's a euro stablecoin, right? There are Korean won stablecoins. There are all kinds of currency stablecoins. The FX risk is still there, right? The FX risk doesn't change. It's just that, like, essentially you replace old plumbing of how these currencies used to be settled with new plumbing that is global and instant and much lower cost, right? FX risks won't go away because, again, if anything, we're still using US dollars, we're still using euros, we're still using yens and so forth, but they're just on chain. Simon asks, do you think there will be stable coins for euro or yen? Yep, they already exist. They're just not as popular or common because the dollar tends to be the strongest currency. Like if you look over the last few years, maybe except for recently where I think euro just gained some strength after Germany bought like $1 trillion worth of guns. The dollar has been crushing most currencies over the last 10 years. So people tend to park their money in US dollars. Plus, all the exchanges like Binance, Bybit, and so forth, they use USDT as a counterpair. Will they be issued from governments or also private public entities? Or will this be a US-focused topic? I think I mentioned this earlier. It will be both. It will be both. Right now, private entities are launching these, right? That being said, I place it at 9 out of 10 that Europe will launch some KYC CBDC where you will get your Euro wallet that looks like it's from early 2000s UX, right? And you will have to KYC, meaning you have to show your passport, use your national identifier, and so forth. And it will be better than what you currently have, meaning you can probably use, I was going to say you can use Apple Wallet. It's probably not compatible with Apple Wallet because Apple and Europe always get in fights. But you can use an app on your phone and like check out. Even like when you get a croissant in Paris or you get a kebab in Berlin, you see what I did there. It's like you can use the app, right? It will probably be some CBDC payment rail that is fully KYC'd and you're very much under the eye of the government. Yeah. And they'll probably forbid corporate stable euros. I would not be surprised. The European Central Bank will probably go after stablecoin issues that issue euros. I wouldn't put it past them. Michael, why people should buy ETH instead of Solana? Why should people buy Solana instead of ETH? Why is the industry using ETH more than Solana? Safety. Thanks for the. Okay, so it's really either Solana, Solana over ETH, yada yada. Okay. People are transacting on ETH over Solana, I think primarily because one, path dependency. You started using DeFi in 2020. You're used to it. You have made the jump. I genuinely think that's a big piece of it. Because once you use Solana, you're like, whoa, this is like way faster, way smoother, better, you name it. That's one. Two, the people that care about decentralization, right? So yes, ETH is more decentralized than Solana. Like they're both decentralized to some degree, but like ETH is more decentralized. So if you really care about that, and you should, right? Then yes, you might use Ethereum more, or you might use Ethereum for like the really valuable things. That being said, trillions in value have flown through Solana, and there's never been a 51% attack, right? Like if you really believe that it's vulnerable, it would have happened at this point. There's enough money on there to steal for it to happen. There's enough incentive for a bad actor to break it, and it hasn't happened. And then why is the industry using ETH more? I think huge chunk of it is path dependency, and that applies also not just to users but also to developers and to commerce, right? So, for example, if you accept crypto as payments, right, you probably onboard ETH, you probably onboard Bitcoin, you might not have onboarded Solana yet, right? If you're a developer, let's say like OG, like Stani, right? Stani is the founder of Aave, right? They built on ETH, they built on all the layer twos, and everything is built on Solidity, right? Solana is built on Rust. So like for some reason, many of them have chosen we're Camp ETH. It's a little bit tribal. We're not going to move over to Solana, at least yet. And to make matters worse, there's competitors on Solana. Like there's Camino or Kimono. Camino. It's called KMNO. They're like the Aave of Solana. And silly enough, like the Solana Foundation, Kyle Samani and Stani, they got into a fight on Twitter where Solana tried really hard to say Camino, I think it's Camino. Camino is better than Aave, right? And so then why would Stani move over and work there, right? So I think tribalism is an issue. So tribalism is an issue. Path dependency is an issue. Decentralization is an issue. That's it. But honestly, I think on a long enough time horizon, Solana is probably going to continue winning. And I say this because, yes, the meme coin casino blew up, and a lot of traction for Solana was based on that. That being said, Ethereum only scales with layer 2s, and the layer 2 experience still is pretty suboptimal. There's a lot of fragmentation, a fragmentation of apps, a fragmentation of liquidity, a fragmentation of token access. Even like, one time a token launches, you can only get on Base. Then a token launch, you can only get on Arbitrum. Then a token launches only on ETH mainnet. And it's just not a good experience. And so I think Solana will probably continue to grow. Let's see this. 5 more questions. I'll be quick. When is the first session online? The first session is already online. There's a YouTube channel. If you go to YouTube and you search Hartman Capital, you will find session 1. I haven't promoted much yet. I will. And this one will be uploaded too. Do you think there will be a comeback of privacy crypto projects? So the thought that came to mind is that I think privacy crypto will come back the same way that ARMs only do well when you need it. So I was talking to some Germans, and they mentioned, like, for example, in Germany, there's this company called Rheinmetall, which does like arms in Germany, like weapons, tanks, fighter jets, and so forth. And they're just going through the roof now, right? A lot of arms manufacturers, they do really poorly, and they underperform the S&P, call it 9 out of 10 years. And then when war comes, they just go ballistic, up and to the right, right? I would put privacy in a similar category where privacy tokens historically underperform the wider crypto market. Why? Because first of all, centralized exchanges tend to block them out. You can't get access to them very easily. And then during good times, very few people feel the need to use it, right? Unless you're a cypherpunk or you do something illegal or you're a hardcore libertarian, you probably don't use Monero, right? Again, not just if you're criminal, but also maybe if you're like hardcore care about your privacy, sure, right? In good times, that means there's going to be very, very little traction. More challenging times, more tricky times, when you're like, hey, can I trust the government? Hey, will there be a war? Hey, do I need to exit my money out of the system? During those times, there will be a tremendous uptick, right? If they weren't so awfully horribly priced, which they are, like I would probably buy, like if I would buy like a leap option on Monero and Zcash, like 3-year leaps, right? I can see that being a decent play, right? But it's not a decent play because it's mispriced. Like my assumption here is that if the token is worth $30, the 3 leap option will probably cost you 15. So at that point, you might as well just buy spot and take the market risk, and have more than 3 years. It is worth mentioning something that I've noticed is Monero has actually done surprisingly well in the last few months. So maybe there is, again, increased fear of global conflict, increased fear of totalitarianism. It's probably an uptick in privacy tokens. We only got 3 more left, and then we'll wrap it up. Appreciate you guys all staying till the end. We got anonymous attendee. What will be the next bull cycle catalyst? That's definitely German person, Katalysator, in your view. Stablecoin framework or just liquidity? Look, I am against I go against the grain here. All the big talking heads think it's all just a function of liquidity, like Raoul Pal, and like post a picture of the M2 money supply expanding and Bitcoin declining every 6 hours, it seems. Much respect to Raoul, but there's a lot of people that essentially think it's all just liquidity play. And yes, there is some track record that liquidity does correlate to crypto pricing. Here's the reason I'm not 100% bought into that idea. I'm not 100% bought into the idea because you have options, right? When the stock market is doing well, why would you buy a random crypto token that is becoming less and less scarce over time? What I mean with this, when I first, in 2017, I used to teach about crypto. I had something called Crypto Academy. And when I did my first live session, I think there was maybe 500 tokens in the world. I think there was we were sub 1,000. We were sub 1,000 tokens back then. Might have been 500, might have been 300 on CoinMarketCap. And you can see this, there's a historical view where you can see historical views of like what tokens were around. Today, we're talking about 20,000 tokens listed on CoinGecko and CoinMarketCap, and millions that aren't even listed on, essentially meme coins and other tokens that just haven't been made their way to CoinGecko, CoinMarketCap. If you ignore the millions and just say 20,000, it's increasingly competitive, right? So I think the days of people just blasting their savings into a random 3-letter symbol, like look at layer 1 blockchains like EOS, IOTA, NEO, some of the stars from 2017, it's down only, right? So if the stars from 2017 are down only, now we're starting to see some of the stars from 2021 are also down only, right? There are exceptions to the rule. Of course, there are real projects that make that have a real product, create real revenues. Like look at the chart of Solana, look at the chart of Aave, look at the chart of Chainlink, right? They're actually making year-over-year progress, right? They're making long-term gains. That is not the truth for 99% of crypto, right? So I don't think injecting liquidity will make people come back to the casino that just took 90% of the money, right? Will the casino always be there? Yes. But I do think we need some underlying fundamental traction that makes people believe again, right? Because you can't just spin a new narrative every 3 months and then it's just boom and bust, right? We had the AI narrative, for example, where tokens like Virtuals or AI 6Z or ARC, right? They went to billion valuations, and now they're back down 95%, right? So we can't keep having this musical chair game, essentially. And so to me, I think the real catalyst is real world traction. Where do I think real world traction comes from? Well, I wrote about this in my article where I said, essentially, for there to be a new catalyst, for there to be a new bull run, right? The next marginal buyer has to be Wall Street, right? Because retail is burned out. Retail is burned out. And how to get Wall Street to buy? Well, Wall Street probably isn't buying meme coins. Wall Street is going to buy something that they can wrap their head around, right? With real revenues, real users, they can use a traditional analysis, right? They find exciting. That's probably going to be DeFi, right? But then you look at DeFi and say, well, what is most ready in DeFi? Meme coin trading is super, like a lot of DeFi is reflexive. Reflexive, what we say when, why do DeFi protocols have revenue? Because let's say there's trading and there's borrowing. Okay, but why do people trade and borrow? Well, in a bull market, because there's a lot of hype and more people trade, right? So now you've got this reflexivity where if you go into bear market, less people trade, which means less trading fees, which means DeFi makes less money. Oh no, so now people look at the DeFi and say, oh, well, Uniswap has much less volume, it's dying, so it's worth less. And so then DeFi 2 is reflexive, right? Stablecoins is the one entry point that is no longer reflexive to the market, where people can transact more year over year, whether or not crypto's in a bull market. And to me, that's the place where we have PMF. It's gonna take off. You're gonna have trillions on chain. You're gonna get more activity, and it's gonna have ripple effects, right? Because stablecoins go on chain, DeFi will have more, lending markets will have more revenue, exchanges will have more revenue, bridges get used more, layer one blockchains get more settlement fees, right? Like everything goes up. Of course, at that point, more innovation and more speculation will be sprinkled on top. But to me, that's the kickoff point, really. In which time frame do you expect stablecoin framework as next announcement in the list? I think I mentioned this, 2 to 6 months. And again, because it's not just an announcement. Like an announcement will happen, but the announcement is already priced in my eyes. You might have noticed this, that like Trump says we're doing a Bitcoin stockpile, and market goes down. Why? Because it's priced in. We've heard about this in June. We talked about it again all throughout, right? At that point, it was buy the rumor, sell the news. If you were surprised to hear that there's going to be Bitcoin stockpile, you've been asleep at the keyboard, right? So ultimately, I think most people in the industry are aware that stablecoin frameworks will come, but they've largely ignored it. Why? Because it's not an immediate trade. You're like, well, what does it do if people use Tether, right? You do have to think one step further. How does the use of Tether or USDC impact the whole ecosystem? Who will benefit? Which this whole presentation was about. And I think Wall Street and a lot of retail investors, I don't think have wrapped their head around yet, like what the stablecoin opportunity is. Again, because it's not such it doesn't sound like a hot subject, right? Armin, final question. I appreciate you guys staying till the end. Armin asks, with stablecoin issuers now holding a significant share of US treasuries, how might their growing role in debt markets reshape treasury issuance strategies? Thinking about this one. Okay, I probably need to think about this more. The one thing that does come to mind is that the US has actually an incentive to push stablecoins. Why? Because stablecoin issuers become the new marginal buyer of US debt, right? Part of the issue is that there's fewer and fewer institutions that want to buy US debt, which is why even though we're cutting rates, the effective rates are going up, right? Because there isn't enough demand in the market. And so I could see, like, if we have a proliferation of stablecoins, right? Like let's say another 10% of M2 is going into USDT, right? Well, USDT wants to monetize that cash, right? And so they will likely be a net buyer of treasuries, which works out well because, the US needs additional capital, right? That's the only way, but this is a deeper question, so I can think about this more, but I would say that's something worth watching. Awesome. Well, this was an incredible session. We about 90 minutes. Hope you guys enjoyed. I know many of you stay till the end. I see a lot of our LPs in here. I appreciate you guys because especially our LPs, you are what makes all this possible. I think the year ahead for crypto will be interesting. Right now, the next 2 or 3 months, I believe it will be rather risk off. It will be rather tame. There might be some sell-offs. We're positioned for that. We're largely in cash right now. But I do think the interesting trade to stay for is this, what we talked about today, over the next 3 to 6 months. And when you look at the scope of that, I think we're extremely early. Because, for example, all of DeFi is only about 75 billion, right? All of DeFi combined is about $75 billion in market cap, right? I talked about this in my write-up, which is only half the size of Uber, right? So this is we're tiny right now. If this is going to replace traditional finance, which the first step towards that is stablecoins, I do think that pocket will grow materially, right? And at that point, you're not looking at, oh, well, Bitcoin went up 30%, but altcoins only went up 10%. I think the picture will change completely, where Bitcoin will become digital gold and it will compound year over year. Nice, great, right? But the real growth, the kind of returns that people are even flocking to crypto for, will come from the products and technologies that are able to capture all the volume and transaction activity happening on chain through both tokenized stablecoins, tokenized real assets, and so forth. So I think that's an exciting trade worth staying for, being involved in, and what we've been focusing on. So with that, hope you guys enjoyed today's session, and this recording will be uploaded to YouTube, and I look forward to seeing you again in 2 weeks for our next session. Have a good one. Bye-bye.